And on today's show, how private self-funding can leverage your premium dollars. Part 1 of this week's series on self-funding index universal life for income with premium funding strategist and attorney Robert Strauss. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Innsmark, Life Specs, and backroom technician. Let's get down to business. Welcome to the show, Robert.
Thank you, Steve.
It's good to have you back again. I really enjoyed our series on premium financing, and that was traditional premium financing, going to the bank and so forth.
Sure.
But today we're talking about self-funding. Now, when I first heard you talk about this, I was kind of amazed. I really didn't think along those lines before. But before we get into that, let's talk about what basic premium financing is, whether we go to the bank or whether we're going to do, which is this whole week, self-funding.
Sure.
Let's walk through it.
Sure. Well, premium financing obviously is using other people's money, generally bank money, to fund a life insurance policy. And the advantage of premium financing really is it lowers the cost of purchasing life insurance and generally makes it a lot easier to buy life insurance. Clients only have to pay relatively small interest payments rather than large premium payments to purchase the life insurance. So it's a lot less costly. And those interest payments can also be made very, very flexible. Often they can dial in their own interest payments or even pay nothing at all up front if they so desire, because whatever they don't pay is generally accrued or rolled up into the loan and can be paid back at some later date.
Now, when we're looking at this, though, we're going from premium financing to traditional thinking, which is I'm going to use this going to a bank and lender. But this week we're talking about none of that, right?
Exactly. This is a little bit different.
But the theology behind it, the background, the structure is still similar.
Correct. So we went from premium financing to SFI, which is self-financed insurance, which was a way to get out of the premium financing loan a lot sooner by introducing arbitrage, to private SFI, which is what we're going to be talking about today, which is literally taking the lender out of lending altogether. So it's kind of that's kind of the history of how we arrived at where we are today.
Okay, so I want to pay interest payment anytime I can leverage it. I want to pay interest payments rather than premium. I want to be able to play today because the interest rates are so low.
Sure.
I mean, they're just extremely low. This is a great market to do this. I also like the ability that they can accrue to keep the outlay low and the cost flexible. And the policy could be collateral. And this is a little different because the bank, it's always collateralized.
Right.
Depending upon who we're talking about here, it may or may not be collateralized.
Right.
And then it makes getting into a large life insurance policy easy. And especially for people who understand this and want to leverage their own assets, this is a huge play.
Right.
But let's look at some of the things there's some con issues here because, interest rates could go up.
Exactly. So there's a lot to like about premium financing, but there's also a lot of risk that premium financing introduces as well, such as long-term interest rate risk. Borrowing from a bank obviously is going to expose you to uncontrollable interest rates. It's also very difficult to sometimes get out of that loan. Once you borrow that money to pay those premiums, how do you pay that loan off? It takes often many years for the cash value in a life insurance policy to build to a point where there's enough cash there to pay off that loan and have that policy continue to perform.
Now, outside these 4 things that you need to look at to make sure you're understanding, when we're doing self-funding, we're not going to a bank, so we must be going somewhere. So when we're looking at, you have 3 different, and I have to tell you, when the first time I heard you say this, I was like amazed. I think, I knew this, but I never put it together like you did. And I think many advisors will have the same reaction. This is really great. Walk me through the 3 basics.
Well, again, the idea here is to keep the leverage, but get rid of the lender. If we can get rid of the lender, we get rid of a lot of the things that go wrong with premium financing. So where can we go to borrow money? Well, there's basically a few different sources. With corporate private SFI, we can go to the employer or a corporation, typically the employer. Intrafamily private SFI will go to typically a family member. We'll use that for intergenerational planning. Asset-based private SFI will go to ourselves. We'll literally lend money to ourselves. We'll take money from our left pocket and we'll move it over to our right pocket.
You're not just redistributing assets here. You are actually lending the money. Isn't that correct?
Exactly. We're lending money from literally the funding source to the policy and then reimbursing the funding source at the end of the 10th year, as you'll see in a minute.
Okay, so if I'm a high exec and I want to look at corporate,
Correct.
and I'm looking at corporate funding, that corporate funding, then I could go to my employer and say, hey, this is one of the perks I'd like as an executive, and I go ahead and I ask for that. Or I could go to my own account, as you were suggesting, go to my own account and say, but I'm not just redistributing assets, I'm actually lending it.
Well, when you lend to yourself, you're obviously not going to charge yourself interest. So in that situation, it's a little bit different. We call that asset-based private SFI. And instead of interest, it's really opportunity costs that you're going to be foregoing. So that analysis that we do for asset-based private SFI is going to be a little bit different than the first two. So in that case, it's not truly a loan. It's more of an opportunity cost in lieu of an interest rate. And we'll talk about that.
And then the last one was the family. So I could be maybe going to somebody that actually has money in my family, showing him this. They could loan us the money to do this. They're really basically taking the bank's position.
Correct. And as long as it's an arm's length loan at the AFR rate or higher, then there's no gift tax. There's no it's a true loan from a family member to another family member.
And the AFR rate is really low.
2.67% the last I checked.
Right, it's really low.
The long term.
Right, the long term. We come back from the break, we're going to continue talking about this because this is a whole different animal. This is not premium financing as we know it. This is really funding with other assets, other people's assets, maybe even your employers. We'll be right back after the break. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Welcome back to our second segment. Of course, we're with funding strategist and attorney Robert Strauss. And Robert, we're talking about your basic premise, leverage, and this is a patent pending methodology, a copywritten methodology that you came up with using IUL. The leverage. I'm paying little interest instead of paying my premium.
Correct.
So that's the basic of your leverage program.
That's the basis for leverage. Correct.
Okay, now I'm thinking about this when I look at this on your ledger statement. When I do a regular ledger statement on an IUL, it shows me the internal rate of return. If I'm adding leverage to this, my internal rate of return is going to go through the roof.
Sure.
I mean, it's the multiples. I mean, we're already using the leverage at the front end. Now we're using with IUL in that. I want to fantasize what that looks like. And we'll see some of that throughout this week.
Right.
After we know the leverage, we're paying a small amount of money here. Instead of paying the premium, we're paying interest only on the premium. Now let's talk about arbitrage, because this is really where people kind of say, this is the nuance. A lot of our advisors go, I know what arbitrage means, but what does it mean in an index universal life contract?
Well, in an index universal life contract, what it means is getting a crediting rate that exceeds your policy loan interest rate. So what we're trying to do here is pay back the funding source. We create leverage by borrowing money from the employer in the case of corporate private SFI, borrowing money from mom or dad in the case of
family,
intrafamily, or borrowing money from yourself in the case of asset-based. And at the end of that 10th year, we're going to pay back that funding source in a way that creates arbitrage. So we take out a policy loan, which is always going to be a participating policy loan, which means that the money that you borrow continues to be working for you in your cash account of your policy and continues to be credited. And if that crediting rate exceeds your policy loan interest rate, you're going to have arbitrage, at least in that year.
Okay, so if I'm hearing you correctly, then my index universal life policy has to have kind of a stable interest rate. Now, I noticed that in your formats, you usually choose one that's guaranteed for the life of the contract. So once you select the fixed rate, which is a lot of your examples I've seen is 5%,
correct.
I already have I have a certain event now. Correct. I can bank on it.
Correct.
So if I exceed that 5% in my return, let's say for discussion's sake, S&P 500, then everything above the line is a positive arbitrage.
Correct. It's not SFI, and it's certainly not patent pending SFI if a variable participating policy loan is used. And until a few years ago, all participating policy loans were variable. So that's a relatively new animal, these guaranteed fixed rate participating policy loans. And that's really critical. That feature is really critical.
And I've heard you say that these are contractual. This isn't just current company practice.
That's right. These are contractual.
Well, then, of course, we add the most obvious thing. Most of our advisors understand the tax-free benefits of taking out policy loans from a contract kept in force for the life of the policy insured. Sure. So this is one of those times where I say it seems like the economics have completely aligned because I'm using the leverage, paying interest versus premium. I'm getting the arbitrage. The moment I go past my fixed loan rate, I get to participate in that amount, if it's whatever's above the line, and then I'm getting tax-free treatment, not only on my income coming out, but any residual that I didn't use in my life will go generally tax-free to my beneficiaries.
That's right. You're getting the tax-free benefits that you would normally get from life insurance, which is always very good, but they're enhanced now. They're enhanced by leverage and they're enhanced by arbitrage.
Okay. In your practice, using self-funding, out of the three, corporate, intrafamily, and asset-based, which of the three, give me kind of a percentage, which one do you think we're using the most now, just to kind of get our advisors an idea what to look for from a prospecting tool?
I would say asset-based. And the nice thing about asset-based is you're not dependent upon anybody else to give you money. And so that makes it very easy to prospect for.
Okay, now, but are you actually charging yourself money or not really?
You're not really.
Okay.
What you're doing is on the spreadsheets, on the analyses that we do, you basically are calculating what the opportunity cost is. So what you want to do is you want to use unproductive assets, the bottom of the barrel, and you want to enter that investment cost, 5% gross, 3% net, whatever that opportunity cost is, into the analysis. And that's basically what you're comparing this to.
So from your large macro view, is that 50, 60% of the time you're selling asset-based before you sell the other two, corporate or intrafamily?
They're very different markets, as we'll talk about. So often in a group sale, for example, if we're doing this for a medical group, for example, there's a big application with corporate private SFI. It's a great retention tool, for example, for young doctors who are often being stolen away by corporate medical groups. So it's a fantastic retention tool. Intrafamily private SFI is a great multi-generational planning tool. It doesn't really cost really anything for one generation to pass assets on to another generation. No gift taxes and virtually nothing out of pocket.
So really these three are actually three demographic prospecting arenas to go after. They're not really interwoven at all. They seem to be distinct.
They're really distinct markets. I mean, I could tell you which is more, which sells more than another, but they're very distinct markets.
Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just go out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. We'll see you tomorrow.